welcome to Macroeconomics with Kathy. Today I'll be covering Topic 2, National Income Accounts. I'll be covering topics like circular flow, GDP, and real GDP versus nominal GDP. So what is circular flow? Well, circular flow is the flow of money, goods, services, and factors of production through the economy. We can model this flow through the use of a circular flow diagram. A circular flow diagram is a simplified representation of the macroeconomy, which helps us to better understand the principles behind national accounts. The diagram represents transactions that take place by two kinds of flows. Number one is the flow of physical things, like goods, services, and labor, and number two is the flow of the payments for these things. We have two types of circular flow diagrams, the simple circular flow diagram and the expanded circular flow diagram. What's the difference? Well, the simple circular flow diagram illustrates a simple economy containing only two groups, households and firms. A household is a person or a group of people who share income. So for example, your parents both belong to a household. A firm is an organization that produces goods and services for sale. In the simple economy, there are only two kinds of markets, product markets and factor markets. Product markets are where households buy products from firms, so basically anywhere that things are sold, like Amazon or your nearby Target. Almost everything around you, like your phone or your shirt, was produced by a firm and sold to you in a product market. On the contrary, factor markets, also known as resource markets, are where firms buy resources that they need for production from households. The best known factor market is the labor market, which refers to the supply and the demand of labor. For example, let's say that you get a job at your nearby Starbucks. This means that you're providing the resource of labor for the firm, Starbucks. Other resources include land and capital. So now that we know how physical things flow, let's take a look at how the money flows. When a good or a service is sold to you, you have to spend money on it. And when a firm buys a resource from you, such as labor, they have to spend money to pay you. From here, we can see that the flow of money into each market is equal to the flow of money coming out. Thus, money travels in the opposite direction as resources. Now that we understand the simple circular flow diagram, we need to understand the downsides of using it. Although this diagram is very simple and straightforward, it actually overlooks a lot of real-world complications. Let's take a look at the expanded circular flow diagram. This diagram is far more realistic. It takes into account government involvement, financial markets, and the rest of the world. So let's break down these three factors. What do we mean by government involvement? Well, government involvement consists of flows to and from the government. Flows from the government consist of government spending, which are the total expenditures on goods and services by federal, state, and local governments, and government transfers, which are payments that the government makes to individuals without expecting anything in return. On the other hand, flows to the government include taxes, which are required payments from firms and households, as well as tax revenue, which is basically the total amount that the government receives from collecting taxes. Next up, we have financial markets. Financial markets are the private savings that leak out of the circular flow. Some households don't spend all of their disposable income on consumption, so the savings that they don't spend sort of just leak out of the circular flow. These savings are often stored in banks, so they end up back in the circular flow through loans. Additionally, financial markets use these private savings in government borrowing and investment spending, so that's just another way that these savings can end up back in the circular flow. Finally, we factor in the rest of the world. By this, it means that we take into account the nation's imports and exports, as well as foreign lending and foreign borrowing. When America exports goods and services to other countries, funds are injected into America's circular flow from the rest of the world. This makes sense because if America sells a product to China, then America gains funds which enter into the circular flow. Similarly, when foreign lending occurs, meaning that foreigners lend to American borrowers, this also generates a flow of funds into America's circular flow. On the contrary, when America imports goods and services from other countries, then funds are leaked out of America's circular flow. For example, if America were to buy a product from China, then America would have to spend money, so funds would leak out of America's circular flow and into China's. Lastly, when foreign borrowing occurs, meaning that foreigners borrow from American lenders, funds are also leaked out of America's circular flow and into the rest of the world. The biggest takeaway from the circular flow diagram is that the inflow of money must be equal to the outflow of money for any market or sector. We also know that circular flow shows all of the final goods and services produced in an economy. So what's the significance of this? Well, if we calculate the total dollar value for all of the final goods and services produced in an economy in a given period of time, typically a year, we can find the economy's gross domestic product, or GDP, which is a very important value for tracking the macroeconomy. A country's GDP does not factor in financial assets, intermediate goods and services, used goods, and foreign goods. Financial assets are intangible assets, so basically stocks and bonds. By intermediate goods, we mean goods and services that one firm buys from another firm as an input for the production of a final good or service. For example, flour would be an intermediate good for baking cupcakes. If we took these intermediate goods into account, it would result in redundancy and the GDP would no longer be accurate. So how exactly do we calculate GDP? Well, there's 3 approaches we can use, all of which should yield the same result. We have the expenditure approach, the income approach, and the value-added approach. The expenditure approach is where we add up the economy's aggregate spending on domestically produced goods and services. We have a formula. GDP equals C plus I plus G plus X minus M. C is for consumers and represents the spending done by households. I is for investment and represents the spending done by firms. G is for government spending, and then X minus M is for exports minus imports, so basically the net exports. Next up, the income approach is where we add up the total factor earned by households from firms in the economy. All of the money that is spent on domestically produced goods and services generates factor income to households. Finally, we have the value-added approach, which is where we add up the contribution of individual firms to the value of each final good or service. To avoid redundancy, however, we only count the value that is added, which is the difference between the value that the good or service is sold at and the input value. Let's try applying these 3 methods of calculation to a practice problem. So in this problem, we're given a hypothetical economy that consists of 3 firms: American Cotton Incorporation, American Fabrics Incorporation, and Nordstrom Rack, the clothing store. We want to apply the 3 aforementioned approaches to calculate the GDP. Starting with the expenditure approach, we add up the economy's aggregate spending on domestically produced goods and services. In this case, the aggregate spending is just $215. Next up, for the income approach, we have to add up the total factor earned by households from firms, also known as the total factor income. In this case, we get 157 plus 36 plus 22 equals 215, which is consistent with our previous answer. Finally, with the value-added approach, we add up each firm's added value, in other words, the value of the sales minus the cost of the intermediate goods, and we get 42 plus 48 plus 125 equals $215, again consistent with the previous 2 answers. Thus, we can see how these 3 approaches are interchangeable and all produce the same final value. Now that we know how to calculate GDP, let's figure out how to interpret it. First, we know that GDP measures the size of the economy, and it gives us a basis of comparison against other previous years or even other countries. The GDP that we're referring to, however, is nominal GDP, which does not take into account the effects of inflation. Thus, it's not a good measure for an economy's growth over time because it often actually overstates the true growth in output. So how do we combat this issue? This is why we have real GDP versus nominal GDP. Unlike nominal GDP, which is what we were discussing before, real GDP is the total value adjusted for inflation. Real GDP shows us changes in aggregate output, which is the total quantity of final goods and services produced in the economy as opposed to the dollar value. So how do we calculate real GDP? We calculate it as though the prices stay constant at the level of a given base year. Thus, we set real GDP equals to the quantity of the current year times the price at the base year. Let's look at an example. In this example, we're given the value of sales of strawberries and mangoes from year 1 to year 2. Since we're trying to calculate the real GDP for year 2, we follow our formula. We take the quantity of the current year and multiply that by the price of the base year, which in this case we set as year 1. The quantity of strawberries in year 2 is 2,400, and the price of a strawberry in year 1 is 15 cents. And then the quantity of mangoes in year 2 is 1,700, and the price of a mango in year 1 is 70 cents. So plugging this into our formula, we get 2,400 times 15 cents plus 1,700 times 70 cents equals $1,550. Thus, the real GDP for year 2 is $1,550. Finally, the last topic we'll be covering is real GDP per capita. Real GDP per capita is the average GDP per person, so to calculate this, we just do real GDP divided by the size of the population. We can use GDP per capita to compare labor productivity between countries. Unfortunately, GDP per capita does have some limitations. It's not a very accurate measure of a country's living standards. First of all, it doesn't indicate the distribution of the income, meaning that it could be entirely skewed and we would have no idea. Second of all, it doesn't take into account a lot of the factors that contribute to happiness, like free time or volunteering. Moreover, it doesn't factor in expenditures that actually decrease happiness, like disease and natural disasters. In summary, today we covered circular flow and the relationship between households and firms, as well as factor markets and product markets. We also covered the two types of circular flow diagrams that we can use to represent circular flow, the simplified diagram and the expanded diagram, and we covered the advantages and disadvantages of using each. Next, we covered the importance of GDP and the difference between real GDP and nominal GDP, as well as how to calculate and interpret each of them. Finally, we covered the concept of real GDP per capita, as well as its applications and limitations. If you have any questions on what I've gone through today, please let me know. Thanks for watching.